In these volatile times, it's rare to hear of a Wall Street company that's expanding, but that's what Cantor Fitzgerald is doing. The firm recently announced it will hire 100 new employees as it expands its equities division. I'm joined now by CEO Shawn Matthews. Thanks for coming in and joining us, Shawn. The thing that jumped out at me about this story is that it seems to be that you're finding opportunities out of these potential regulatory changes in Washington.
Absolutely. As the larger financial institutions have to change and morph based on what regulatory environment is out there, we think there's a great opportunity over the next 3 to 5 years to take advantage of some of the things they may have to leave behind.
Specifically, you're looking at opportunities in derivatives.
We're looking at equities, derivatives, fixed income. Really, the entire business right now we think is in growth mode, certainly on a global basis. But on the equity side of the business, we think there are certainly opportunities as people have scaled back their divisions. It's been a tough road the last year or two, but we think it's bottoming it out, and now there's real opportunity there.
So what are you finding outside of the U.S.? Because we haven't seen a whole lot of coordination on global regulation up to this point. But where are you finding sort of business opportunities trickling down?
I definitely think there will be some coordination over time as far as financial reform is concerned. It'll probably take a year or two, but it'll be there. We're looking at London as a place where there's definitely some opportunity. If you look at the landscape that's out there, the larger institutions now, especially in London, are mostly owned by the governments, as opposed to here where it's a little bit different. So if you look at Europe, they're probably 12 to 18 months behind us as far as getting bad assets off their books. And we think there's a real opportunity as they'll continue to go through hardship and they'll need to change their way they do their business.
Talk to me about the kind of business that may be coming from changes in how hedge funds are investing or behaving right now. We just came off the month of May. It was very volatile. There was a lot of activity out there in non-equity trading, too, as people try to protect themselves. What are you finding? Absolutely.
May was a very difficult month. You had a lot of assets go down in price. There was very little volume, so it was tough to get out of the trades you were already in. We're looking at it. If the financial reform happens, which I believe will, you'll see a lot of new hedge funds pop up as the desks that were inside these banks now have to go and actually be separate hedge funds over time. So there'll be formation of a lot of new hedge funds over the next couple of years.
That's the benefit, some would say, of the Volcker rule for hedge funds.
Correct, which looks like it's going to pass.
So from your perspective, I mean, when are you going to start this hiring? I know you have the intention, just 100
Thursday.
people at this point.
No, absolutely. We're going to start as soon as possible.
You're not waiting until July 4th or to see these bills signed. You're already getting ahead and hiring.
Absolutely. Absolutely. We think the opportunity is right now, and we're aggressively going out to hire people.
Tell me what you're seeing on your desks and from the people who are working there now, right now. We're going into this month off of a heck of a roller coaster last month. Characterize for me the environment.
We've started to see a little bit of bottoming as far as people looking to buy assets. The problem is when you don't feel like there's any liquidity, asset prices are dropping, but you really can't buy assets at lower levels, everyone stands still, right? Because it's very difficult to justify, selling assets when you can't replace them anywhere close to where they are.
Like so much of that's going into treasuries right now.
Correct, because that's the safest opportunity. So if you look at the financial institutions right now, their best play is to put money into treasuries would have a risk weighting that is very low. So on an absolute return basis, it's a very high return because they get a lot of leverage on treasuries.
So with a day like today, if you've been following the markets, I mean, we had some contradictory information. Consumers feeling better, but they were spending less than expected when it came to going to the cash register itself. What is it that you're seeing as sort of the lead indicator on your business right now?
I think the lead indicator is looking at what the customer base is actually trying to accomplish, right? So if you look at the asset liability models out there for some of the plain vanilla institutions and pension funds, certainly they're going to have to look for alpha over time because the liability side of the equation is out there and it's still going to be there over the next several years. So you'll start to see more formation of hedge funds that'll try to go out and get that alpha for those individuals.
All right. Thank you so much. Good luck with the hiring. It's interesting to have a CEO on who says he is hiring right now in this environment. So I appreciate it, Shawn Matthews. Thanks for joining us.